Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Diversification Strategies. Diversification strategies are integral to the risk and return theory in finance, forming the bedrock of modern portfolio management. The essence of diversification lies in its ability to spread investment risk across various assets, thereby reducing the impact of any single asset's poor performance on the overall portfolio. This lesson delves into the mechanics, types, and benefits of diversification strategies, supported by empirical evidence and theoretical underpinnings. The principle of diversification is anchored in the notion that a well-diversified portfolio can achieve a given level of return with lower risk compared to individual investments. This concept is vividly illustrated by the Modern Portfolio Theory, introduced by Harry Markowitz in 1952. Markowitz demonstrated that an investor could construct an efficient frontier of optimal portfolios offering the maximum possible expected return for a given level of risk. The efficient frontier is achieved through the diversification of assets that do not perfectly correlate with each other, thereby mitigating unsystematic risk. Risk in investment is categorized into systematic and unsystematic risk. Systematic risk, also known as market risk, affects the entire market and is unavoidable through diversification. Examples include interest rate changes, inflation, and geopolitical events. Unsystematic risk, specific to individual securities or sectors, can be virtually eliminated through diversification. By holding a mix of assets, the negative performance of some investments may be offset by the positive performance of others, thus stabilizing the portfolio's returns. Empirical studies reinforce the effectiveness of diversification strategies. For instance, a study by Statman found that the risk reduction benefits of diversification begin to plateau beyond holding around 30 stocks in a portfolio. This phenomenon is due to the diminishing marginal utility of adding additional stocks as each new stock contributes less and less to risk reduction. However, the exact number of securities required for optimal diversification can vary based on the market and the correlation among the securities. Diversification strategies can be broadly classified into three categories: asset class diversification, geographical diversification, and sectoral diversification. Asset class diversification involves spreading investments across different asset classes, such as equities, bonds, real estate, and commodities. Each asset class reacts differently to economic conditions, reducing the portfolio's overall volatility. For example, during economic downturns, bonds often perform better than stocks, cushioning the blow to the portfolio. Geographical diversification extends the principles of asset class diversification to different regions and countries. Investing globally can protect a portfolio from country-specific economic downturns and political instability. Research by Solnick demonstrated that international diversification could significantly reduce the risk of a portfolio compared to domestic-only investments. This is because economic cycles and market conditions differ across regions, providing a hedge against localized risks. Sectoral diversification involves investing across various industries and sectors. This approach mitigates the risk associated with sector-specific downturns. For instance, the technology sector might experience a downturn due to regulatory changes, but other sectors like healthcare or consumer goods may remain unaffected or even benefit from such changes. By allocating investments across sectors, investors can smooth out returns and avoid concentration risk. Diversification is not without its challenges and limitations. One issue is the potential for over-diversification, where the benefits of adding more assets to a portfolio are outweighed by the costs, such as increased transaction fees and complexity in managing the portfolio. Additionally, finding assets that are not highly correlated can be challenging, especially in times of market stress, when correlations between different asset classes tend to increase. as observed during the 2008 financial crisis. Moreover, while diversification can reduce unsystematic risk, it cannot eliminate systematic risk. During periods of market-wide turmoil, even a diversified portfolio can suffer significant losses. This was evident during the COVID-19 pandemic, where global markets experienced synchronized declines, highlighting the limitations of diversification in extreme market conditions. Despite these challenges, diversification remains a fundamental strategy for risk management. Tools such as correlation matrices and optimization algorithms can aid investors in constructing diversified portfolios that align with their risk tolerance and investment goals. Furthermore, the rise of exchange-traded funds and mutual funds has made it easier for individual investors to achieve diversified exposure to various asset classes, regions, and sectors. In conclusion, diversification strategies are vital in managing investment risk and optimizing returns. By spreading investments across different asset classes, geographical regions, and sectors, investors can reduce unsystematic risk and enhance portfolio stability. While diversification has its limitations, particularly in the face of systematic risk and market stress, it remains a cornerstone of prudent investment management. The principles of diversification are supported by robust theoretical frameworks like modern portfolio theory and empirical evidence, underscoring its importance in achieving a balanced and resilient investment portfolio. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.